Assalamu alaikum wa rahmatullahi wa barakatuh. I'm Areen Zahir Atani from Jordan. I want to thank Dr. Noor Adli, Ridwan Shah, and all organizer of SAIS 2020 who gave me the chance to present my research paper using online video. The title of our research is Analyzing the Effect of Liquidity Risk Management Indicators on the Financial Performance of Banks, Evidence from Jordan. The research methodology, including sample 15 Jordanian listed banks, period from 2013 to 2017. The resources are annual reports and World Bank, and we use random effect regression analysis. The framework of this research paper, including independent variables, dependent variables, and control variables. Independent variables, including 5 ratios: current ratio, loan to deposit ratio, loan to assets ratio, and cash to deposit ratio and leverage ratio. The dependent variables, including ROA, ROE, and Tobin's Q. The control variables includes board size and gross domestic production. The hypotheses of our research included 5 hypotheses. There is a significant association between current ratio and bank performance. There is a negative association between loan to deposit ratio and bank performance. There is a positive and significant association between loan to assets ratio and bank performance. There is insignificant association between cash to deposit ratio and bank performance, and there is negative and significant association between leverage ratio and bank performance. The empirical finding of this research is there is a significant and positive relationship between current ratio and ROE and Tobin's Q. There is a significant and negative relationship between loan to asset deposits ratio and ROE. There is a significant and positive relationship between loan to assets ratio and ROA and ROE, and there is a significant relationship between cash to deposit ratio and all dependent variable, but negative relationship in ROA and ROE, and positive relationship with Tobin's Q. And there is a significant and positive relationship between leverage ratio and all dependent variables. There is insignificant association between board size and all dependent variables, and there is a significant and negative relationship between GDP and Tobin's Q only. The explanation of a positive relationship between the current ratio and bank performance is that mean there is a high liquidity. High liquidity is a sign of financial strength of banks. High liquidity, that means there is ability to pay all daily expenses. High liquidity mean safety margin for eventual downturns, and there is a guarantees for highly profitable investments that demand immediate payment. There is a negative relationship between loan to deposit ratio and bank performance. That means there is a high liquidity risk. High liquidity risk will affect negatively on the profitability of banks. How? That will diminish income from lending-based business, and that will cause lack of customer confidence, particularly if withdrawal demands cannot be met. Loan to assets ratio indicates low liquidity of the banks, thus increases interest income, which affect positively on the profitability. Cash to deposit ratio. When we say cash to deposit ratio, that means higher cash in balance and reserve, higher liquidity of the banks, which affect negatively on the profitability of banks. Leverage ratio. There is a positive and significant relationship between leverage ratio and bank performance. That means the level of debt are worth for the banks. Why? Due to the tax saving in the banks that is stemming from increased interest expenses. Finally, when we talk about the gross domestic production and the negative relationship between GDP and bank performance, we can explain that by supporting the view that high economic growth improves the business environment and lowers banks' entry barriers. Consequently, increased competition that will dampen the profitability of banks. The recommendation of this research paper, Jordanian banks should concentrate on the quality of loans and also the loans assessment procedure. Secondly, that should concentrate on their liquidity position to resist the liquidity crisis in the market. Finally, that should trade off between liquidity position and the profitability of banks because of them is significant for the financial strength of banks. Thank you so much.